everybody and welcome back. This is Swati Gupta, Chartered Accountant. With multiple examples, we'll try to understand how control differs on acquisition or disposal of any percentage holding by the investor. Okay, let's see. For example, initially there is percentage holding. Currently, you are having 10%. Okay, the investor is having 10%. The investor acquired 45% more holding. This means now the current holding is 55%. Here, initially there was no control, but after acquiring this 45% additional, they have got majority shares. They have got control. This means control has been gained in this situation. Similarly, for example, currently the investor is having 60% holding in a particular entity. Now, it decides and it acquires 20% more holding. This means now the holding percentage is 80%. Okay. Initially, there was majority, initially, there was control, and now, after acquisition, there has not been any change in control. Instead, the control has been sustained, has been retained, and therefore, this situation is known as control has been retained. Okay. Now, next comes 20%, for example, currently is your holding, and the investor takes up a call to add up 25% more. Now, the answer, the new holding comes is 45%. Initially, there was no control. Now, also there is no control. It was only significant influence. Here also, it is only significant influence. It is not a control. So, here neither control has been gained nor lost. Still, no control has been gained. So, this is the case of acquisition. Whereas here, we'll talk about sale, or you can say disposal. Now, if any investor decides to sell off any sort of percentage holding, what happens to the control? How its accounting is done? As we know, in this case, you have to prepare CFS. In this case, you have to prepare CFS, whereas here, you are not required, no CFS is required. Let's see what happens in the sale case. This is acquisition and this is sale. For example, currently, the investor is having 90% holding. It decides to sell off, to dispose of 15%. This means the remainder is 75%. Initially also there was majority, and here after disposing also, after partial disposal also, there is 75% holding. This means the subsidiary remains subsidiary, no control is lost. Okay, so control is retained. Simply another situation wherein 90% is current holding, but the investor decides to sell off 60%. Now the answer, the new holding that is remained is 30% holding only. Initially there was control, the investor was the majority holder. Now after selling of this, after disposal, it has become an associate. It does only has significant influence and not control. And therefore we'll say that, the control has been lost. The control has been lost. Okay, you can say that control has been lost. Now the subsidiary has become its associate. Instead of full consolidation, you have to go for the equity method. Okay, these all methods, these all examples and multiple Excel sheets are explained in full course, and the link for the full course is available in the description box. So please download the app from the description box and check out the new courses if it suits you. Okay, please enroll and start learning. Next, last case comes as 90%. For example, the investor decides to sell off 82%. The remainder is only 8%. Right now, there is no significant influence, there is no control. The only 8% share is holding is remaining. This means now control is lost again. And in this case, it has to be accounted as your financial instrument and not as subsidiary. Instead of recording it as a whole consolidation and CFS, no CFS is required over here. Instead, only investment in financial instrument is required. Okay, let's see how its inference is taken. If you talk about disposal, disposal simply means sale. Okay, so you have to check whether the control is retained or not. If retained, then the subsidiary remains subsidiary and you have to carry on and prepare CFS. Whereas if you call for, if the control has been lost, then you have to check if there is full disposal, no CFS required. In case there is only single subsidiary, the entire subsidiary has been sold off. Okay, this means there is no CFS required. no consolidation required. Here, in case if there is control is lost, partial disposal, then you have to no CFS required, and you have to follow equity method of accounting for associate. Whereas if we talk about subsidiary to investment, that means the last case wherein from 90% they have sold 82% and only 8% is left, you have to record this as financial instrument. And here also, undoubtedly, there is no CFS required, no CFS. Okay, these are some important tips and tricks and little crucial pointers that I want to highlight using these small videos. Okay, if you're really interested, if you like the way I teach, okay, there is a professional course and there is a student course. Those are separate. Okay, if you have a time crunch and you want to still understand entirely the IFRS, Indians, their concepts, simple examples, okay, so do check out the description box. There's a link for newly recorded professional batch. Do get enrolled for the same. This is Swati Gupta, Chartered Accountant. See you in the next video. Still then, take care, be safe, stay tuned.